QuickBooks Online 2025. Add new accounts and opening balances. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 project file we set up in a prior presentation. Continuing on here, laying down the foundation, similar to putting in place the infrastructure in a city before we start to build on it. The building blocks in our accounting system being, of course, the double entry accounting system, the transactions being entered with the use of the forms located in the plus or new button, broken out by cycle. But before that, the foundation items, the infrastructures typically found under the cog, including the major lists of the chart of accounts, as well as the products and services. We're continuing on adding our chart of accounts and beginning balances that we're imagining are coming from our prior accounting system. Last time, we took a look at the accounts receivable, the inventory, and the accounts payable, or the last multiple times we looked at those items, which are typically the more difficult ones to add if we have an accounting system that deals with them because they have more complex subledgers we have to deal with. Accounts receivable having a subledger by customer, inventory having a subledger by item or inventory item, accounts payable having a subledger by vendor. We're going to try to add all the rest of them at this time, hopefully these being easier because we have less need to do weird stuff for a subledger purpose, although these accounts still have some of their own particular difficulties that we'll try to point out as we go through them. Our general idea will be the same. We want to have the cutoff of the prior accounting system, in our case as of 12/31/2024, so we can start entering new data in the current system, January 2025. Therefore, we printed out our balance sheet, not the income statement, because there is no income statement because it closed out to the balance sheet as of the end of the prior period. And we're going to, instead of entering each of these or all of them at one time with one journal entry, entering them instead one at a time, which means two accounts are affected, which each transaction, the other side of the account being some type of equity account, whether that be retained earnings, opening balance equity, or the income statement, which will roll into then the retained earnings as of January 1st, 2025. Then we'll adjust the equity section, which we'll do in a future presentation. All right, so we've got the checking account. Just a quick recap of these. The checking account has its own little kind of problems and issues in that it needs to be connected to the bank feeds oftentimes. That's not really an issue to set up the beginning balances usually, although we do have to be careful that when we pull in the bank feed data, that we're not duplicating bank feed data that's already included in here. One of the more difficult problems oftentimes is that there might be outstanding items, outstanding checks, for example, that are included in this balance, which makes the reconciliation process a little bit more difficult. That problem will not arise or come to head until we try to reconcile, which we will do in a future course or section. We've got the furniture and fixture and the related accumulated depreciation accounts. Now, these ones do have subledgers that will break out the depreciation, but usually in the United States, we have those subledgers in another accounting system, such as the tax software, that being because we have to calculate depreciation at least on a tax basis, even if we're a small business, and it doesn't make sense to have such a complex schedule as the depreciation schedules done in two different systems, even if using two different accounting strategies, tax bases versus generally accepted accounting principles, for example, because it's too complicated. So what we would rather do is have the tax software do both of the calculations. So we'll talk more about that when we get there. The Visa, similar situation to the checking account. You have to connect it to the bank feeds, so we don't want it to have multiple data that we're pulling in that would be duplicated from the prior accounting system. But usually we don't have the same problem with the bank reconciliations because we don't have any outstanding transactions oftentimes with a credit card because we usually just pay the credit card or enter them as they become due. Loan payable is usually pretty easy to put on the books, the loan payable, and continue with it going forward. And then the opening balance equity, which will be the result of all the transactions, which we will then adjust at the end. All right, let's go into the checking account first. Noting, again, the checking account usually would be connected to the bank feeds. Now, so what you have to be careful of is if I come from the prior accounting system, I have my data that says there's $25,000 in the bank account at this point in time. I could try to pull in all the data from the prior accounting system, which would come up with that $25,000, making it easier for me to connect to the bank feeds possibly at that point and go forward, and having the bank reconciliations hopefully pulling in as well. But what we want to do here is make that cutoff as of 12/31/2024. So if I pull in the 25,000 here, I've got to make sure that when I start to pull in new data from the bank feeds, it's not going to duplicate any of that information or miss any of the information, which should be fairly easy because hopefully that 25,000 is correct as of the cutoff. So when I pull in new information from the bank feeds, I'm going to start pulling in that new data January of 2025. If I pull in information from before January, I'm going to have duplicated data that will be from 2024, which is already included in the 25,000. Now, the other problem is that if I look at the bank statement might have a different number. For example, as of 12/31/2024, the bank might say that we have $30,000, whereas we say that we only have $25,000. Does that mean we're wrong? No, it doesn't necessarily mean we're wrong. It means that there might be outstanding checks. So checks that we wrote or that in the system we knew about that the bank doesn't know about. That's why we do a bank reconciliation. So that also means that you do not want to go to the bank and then try to enter the bank balance of $30,000 instead of the $25,000 that we had in our prior accounting system, because then our owner's equity won't tie out. So if this number is different than the number that's on the bank statement, I have to choose this number and then fix it going forward. Why? Because this is the number that makes the equity correct. If you start changing these numbers that have already been finalized, that have already been used to make tax returns and financial statements, then you're gonna mess up the timing difference, and so that'll mess up the timing. Your retained earning will be basically off going forward. All right, so that's going to be the idea. So other than that, it's pretty straightforward. We can go back on over and say if we go into let's go into the transactions. If we look at the chart of accounts, closing the ham boogie, the chart of accounts has a cash account that they gave us by default. Now, again, so what we could do is we can change that maybe to the checking account. We might want to call it, the checking account. And then we could connect it basically to the bank, or we can make another account that would be a bank account type of account. Now, if you were to make a new account up top, you've got the new button, and then the account types, which include basically the bank account. As we connect the bank account, note that it's going to have a further complication than other accounts of possibly connecting to the bank feeds. Now, as a general rule, I would say these are all the accounts that pulled in from QuickBooks. We didn't delete all of the accounts. They gave us all of these accounts. So as I add new accounts, I might be thinking, hey, look, I'm going to look for an account that I can use here. If there is an account and I don't like the name, maybe I'll just adjust the name, and then I can use the default accounts that they provided me. And then after I do 2 months of data input, maybe I would go back in here and make inactive all the accounts that I'm not using. That's one strategy that you can use. So that means that maybe I just want to rename this account. So maybe I hit the drop down, edit it, and maybe I'll call it the checking account. Checking. Now you might actually put a number after the checking account if you have multiple accounts, because that will help you to determine one account from another, which isn't great for external reporting purposes because now you have account numbers on there, but is great for internal bookkeeping purposes so you can differentiate one account from another. If you pick up account numbers, you don't want the first few numbers, you want the last few numbers in loan numbers, bank account numbers, and so on. Why? Because those are the differentiating numbers. The first two numbers might be the same. And then this sub account usually doesn't matter too much, but I'll change it to the checking account. It's mainly for referential purposes. And let's save that. Now, as I enter the beginning balances, if I enter the new balance and I edit this item, there might be something down here where I can enter basically the beginning balance, at the bottom as I add a new account. Or maybe I can, if the account is already set up like this one, I can do a journal entry. So in other words, if I hit the drop down, there's different forms that I might use in order to enter a transaction. Right now I'm looking at the checking account. So you would think that if I entered a beginning balance, it might use a deposit form in order to increase the account. Our other option is basically a journal entry, and the journal entry might help us to distinguish that it's the beginning balance. So let's go in here and go into the register and look at it this way. So this is the register, which if you have if you have a whole checkbook, this might look similar here. And then again, we can either use a deposit form or a journal entry. Let's try to use the deposit form. I'll use the deposit form here, and I'm going to put it in as of 12/31/24, the end of the cutoff date. I'm not going to put a payee. I'm going to make this the beginning balance, and then I'm going to put a deposit of 25,000. And then we're going to say the other side, I'll put to the opening balance equity. It's ultimately going to go to retained earnings, but I want to put it into some equity account. So this is just simply a journal entry, basically, that we're going to put in place. So I'm going to say save it. And now let's check it out in our financials. So I'm going to open up the ham boogie and go down to the reports. And let's close up the ham boogie. And then we'll right-click on the balance sheet to open a link in a new tab. Right-click the P&L to open a link in a new tab. So these are our major financials that we are constructing as we go. And then tabbing to the right, close the hamburger. I'll do it for the end of 2024. So let's say 01/01/24 to 12/31/24. Tab and run it. Let's actually look at side by side. If I can look at 2024 and 2025. Let's start doing that. I'm going to change the range from January 2024 to 12/31/2025 and run it. So now I have the same balances, except you can see that the net income rolled into retained earnings. So I think that's a better way to look at it. Let's go to the tab to the right, close the hamburger. Let's do a similar range here. 01/01/24 tab 12/31/25. And then let's look at it by years and run it to refresh it. So here's some of the beginning balances we entered before. No activity in 2025. That's what we want to see. So if I go back to the first tab, if I go into the checking account here in 2024, you can see that it should have a deposit type form, 25,000. If I go into that, it's not going to take me to the register, which is like a simplified place to go to enter the data input, but rather it takes us to the deposit form. That's the form typically used to increase the checking account. Closing it out, going back. The other side, we manually told it to go to opening balance equity, which is the default clearing account that we're going to use until the end, when we remove it from here and put it into, say, retained earnings that we might rename to owner's equity. So there's the 25,000 here, deposit form. So that looks good. Our plan is working. Couple just things to note. The 25,000 here, when I do a bank reconciliation, because I put it in with a deposit, it might not show up as the opening or beginning balance. In other words, it might show up in the detail of the bank reconciliation. That's kind of an issue, but it's not really a problem because you can just check it off when you do the bank reconciliation. So I just want to point that out because let me just show you here. If I go to the first tab and we go to the transactions, we're going to do the reconcile transactions, and then we're going to start the reconciliation. Now the reconciliation, what it does is it takes the beginning balances and then we're going to enter the transactions matching what's on our books to the bank. So there's kind of two problems that I would call the opening balances that could result from what we've done here. One, as we pointed out, the $25,000 here might not match what's on the bank statement of $30,000. So you would think if we were continuing in the prior accounting system, the system would match out to the $30,000 on the bank, but we only have $25,000. Not only that, but this $25,000 beginning balance might not even show up as the beginning balance because we entered it as a transaction. So it might show up in the body of the thing instead of showing it as a beginning balance. Not really a problem, either of those. We'll talk more about that when we get to the bank reconciliation, but I just want to note you're going to run into that issue oftentimes. And why isn't it a problem? Because I could just check it off as having cleared, and then I'll put it in my notes that that's actually the beginning balance. So we'll talk more about that in future sections. Also just note that when we turn on the bank transactions, you can then connect to the bank and then connect to the bank feeds, choosing the bank feed and the account that you want to pick on the bank feeds, remembering that you want to make sure that you pull in the data at the proper point in 2025 going forward. We're going to talk about bank feeds in another whole nother course or section, first looking at the accounting system without bank feeds, because that's the best way to understand then how bank feeds will fit. Otherwise, like we talked about before, you might end up pulling in a whole lot of data from the bank feeds that ends up in bank feed limbo and you don't know what to do with it and you end up with a complete mess. All right, so we've done that one. Let's do the furniture and equipment. Now, the furniture and equipment, this is property, plant, and equipment. Now, you might say that a lot of times people say they want to be on a cash-based system, and that might be the case because you're a small business. That might be easier to do. You're on a cash-based system, possibly for your tax returns. That's what you put on the tax return. But if even for taxes, you're still forced to do some accrual things. So in other words, if you have accounts receivable, you pretty much have to deal with accounts receivable because you have to track the people that owe you money. If you have to deal with inventory, you kind of have to deal with the accrual account of tracking the inventory. And if you buy large pieces of equipment, the tax code's still going to force you to do the accrual thing, which makes sense. You're kind of forced to do it because of the extreme difference in timing differences of when you pay for something and when you use it. So in other words, just to point this out as to why this is a problem, if you were to buy something like supplies, then you might say, oh, look, I'm going to use the supplies pretty soon, so I'm just going to expense the supplies when I buy them. And that would be the easy thing to do. But if you were to buy like a $100,000 building for cash, then you could say on a cash-based system, I should expense it as building expense. But that would be a distortion. So intuitively, you would think, well, that doesn't make sense, though, does it? That can't be right. And it doesn't make sense. Why? Because even though you paid cash for it, if you try to compare your income statement this month to last month, and this month you bought a building for $100,000 and last month you didn't, it's going to look like your performance in the current month is way worse than the last month. And your performance for the month you bought the building will be way worse than the months going forward, even though you're using the building, right? It distorts the income statement comparison. So that means because you bought this, because of this big difference in timing between when you bought the thing and when you consume it to help generate revenue, you kind of have to put it on the books as an asset. But if you put it on the books as an asset, then you need to expense it somehow How are you going to do that? Well, you have to come up with some estimate like straight line depreciation over the life of the building and expense it over the life of the building. Now, you could just reduce the furniture and equipment account itself to do that, or the depreciable account, but you might want to tell the reader, hey, look, it is an estimate. I didn't actually use up some of the building. It's not like we took up a floor of the building and consumed it and it's gone now, and then I expensed it. No, we estimated the cost and allocated. That's why we created another account called accumulated depreciation that tells us the amount that we have expensed of the asset based on some estimate, like straight line depreciation, allocating the cost of the building over its useful life. Now, the other problem is that the tax code might use all kind of wacky other depreciation methods not designed to make the income statement look correct, but designed by politicians, trying to manipulate the tax code or do whatever they're trying to do, right? So that means that I have to track the furniture and equipment, and not only by total, but by unit, by each building, by each car, by each piece of equipment individually, and its related accumulated depreciation, which starts to become a long and messy, ugly report. Not only that, but I might have to track it both on a tax-based system, which is different than the ideal book system, and that becomes really messy. So we don't want to have two systems where I have to track those very complex reports, because it's likely they'll get out of whack. They won't match up to each other. So if we have to do it in the tax return, then we might as well use the tax depreciation software to calculate depreciation for the books as well, is the general idea. And most tax software will, of course, be able to calculate on a taxed basis, but also often has an option to run depreciation schedules on both a tax and book basis. So what we're going to do is not have a separate subledger for furniture and equipment in QuickBooks, because we're going to assume typically it's going to be done in an external tax software. And in that tax software, we can choose for our books to either be on a tax-based system, which we're going to have to deal with in some way, shape, or form to do the taxes, or we can use that tax-based system and tell our tax preparer to also do a book-based system, which is more accurate for reporting purposes, which would be like straight line or normal double declining, no special depreciation, no 179, and so on and so forth. So that's the general idea. Therefore, entering this in our system should be fairly straightforward. Now, there's a bunch of other things with furniture and fixture we'll point out as we get into the adjusting entry processes, but I just want to give a quick point out as we do the beginning balances that it might be a time that you can clean up the furniture and equipment, because it doesn't tie into very well the subledgers possibly provided in the tax return. How does that happen? Well, you might look at the subledgers on the tax return and they have categories of like automobile, and then building, and then equipment, and then furniture, which are different than the categories in your bookkeeping software, which starts to get messy when you're trying to tie out what you're doing to the tax software and do adjusting entries. So what you could do at this point is possibly just make sure that you adjust the categories. We have the same balances in place, but you adjust the categories so that they line up to the same categories that are on the subledgers done in the external software, making the matching up of them easy and the adjusting entries to be entered as easy as possible. So in other words, as you start to put furniture and equipment or depreciable assets on the books, talk to your tax preparer so that you can make the categories as easy as possible, which aren't a big problem when you first start doing them, but over 10 years of having these complex schedules, it's going to get ugly if you don't do it well from the start. All right, that said, we're going to put it on the books as has been given here, and we might do adjustment to it later on. All right, so let's go back on over. Say, okay, let me see in the chart of accounts. So we're in the transactions chart of accounts, closing up the ham boogie. Let's go down and see what they have in furniture and fixtures. See all this crap that they have in here? Building, that makes sense. Land, And then they got this long-term office equipment, and then sub accounts, computer, copiers. They're trying to tell you what kind of things that you might use, and so that they're trying to be helpful. But if you have all these subcategories, it might make it difficult for you to tie into the subledger in the tax software, which might not use this same terminology, long-term office equipment, right? They're probably going to call it just equipment versus furniture and fixture, for example. And then tools and machinery, often not the same category that you're going to see in the tax software. Vehicles, that makes sense. So are any of these furniture and fixture? I don't see one that looks like furniture and fixture here. So maybe I'll change one of these. So in our case, we don't have any land. So maybe I'll just change the land one. The key point is it's furniture and fixture. So maybe I'll just change, I should change this one, but it's got all these subcategories and I don't want to deal with all the subcategories. So I can either make a new one or just change one of these. Let's just change this one as is our normal. So I'll edit this and I want to call it the exact same name. So I'm going to call it furniture and equipment, which also we're going to change later as we tie it into our tax system. But I'm going to first enter it just like it was in the prior accounting system, and then I'll adjust it, which is one way that you could do with that. The subcategory doesn't really matter too much, but I'll change it anyways, and then we'll save it. And now this one, note there is no form specific to entering furniture and equipment. So like, what data input form would I use to buy equipment? Usually if I paid cash for it, I'd use an expense or check form. But in this case, I'm not paying cash for it. So what am I going to use? A journal entry. Now the easy way to do a journal entry is actually to go into the register. All balance sheet accounts, except for like retained earnings, having a register. The register is similar to what you're used to on the cash account only. But this makes it a little bit easier to see the increases and decreases possibly and not go the wrong way when you enter a journal entry. I'm going to enter a transaction, which will be a journal entry as of the cutoff 12/31/24. We'll call it a beginning balance. And then it's going to be an increase of, what did we say here? 75,000. So 75,000. And the other side's going to go into, I'm just going to dump it into opening balance equity. Now, if you started this and added a new account, as you add the new account, it might have a little thing that says enter the opening balance. I'll do that next time. Maybe we'll look at that. And it will probably dump the other side into opening balance equity. So we'll look at that next time in the next account. Let's save this and check it out. So if I go to the balance sheet and then run it to refresh it, and we scroll down, there's the furniture and equipment, 75,000. If I go into it, then we have the transaction detail. It was entered with a journal entry. If I go into that, it's not going to take me to the register, but rather to a journal entry form showing debits and credits. So I'm going to copy this beginning balance and put it on the description on both sides. And then I'll save it and I'll close it. And then let's go back. The other side went into opening balance equity. That's where we told it to go. Dump it into the good old opening balance equity. All right, so there's the 75. Okay, let's go back up. So that looks good. And done. Now the accumulated depreciation is going to be the amount that we have expense. Notice it's what we call a contra asset account, because really these two are kind of linked together. We kind of broke them apart so that we can show more detail, telling the reader that this is an estimate, in essence, of the allocation of the cost over its useful life. So and remember that this 75,000 and this 7,500 actually represent multiple pieces of equipment that would be on the subledger report generated from the tax return, which we'll see later. So we're going to add accumulated depreciation. So if I go back on over here, this is one that always people get messed up. Let's go back. Well, let's just do it this way. Let's go here. Let's go to transactions, chart of accounts, close up the hamburger. Now, normally I would go down here and try to find the accumulated depreciation account. But let's add a new account so that we can see what it looks like when I add a new account. So I'm going to say new account, and I'm going to call it, let's call it the exact same name, accumulated depreciation. Now we could have, well, we'll talk more about that later. We'll say this is going to be account type. It's going to be a fixed asset. That's the important one. And then it says this one isn't as important. It's kind of more of an information, but it's actually accumulated depreciation, not amortization. And notice here, now it gives us this opening balance equity, which we would only use during this process when we're starting the accounts from scratch. So if I enter that, 7,500. The problem here is what does QuickBooks see it? Because we're not using debits and credits. This is why debits and credits are actually more efficient than plus and minus, because now I have a contra asset account. What does that mean? Well, from a debit and credit standpoint, I would credit it. It's straightforward. But from a plus or minus standpoint, it's like, well, is it an asset that I should put a negative 7,500? Or is it saying that the accumulated depreciation account is going up in the credit direction by a positive 7,500? I believe QuickBooks sees it as a negative 7,500 because it sees it as an asset, and therefore it's kind of like the asset is going down. And so that's going to be the idea. So I'm going to put this as of 12/31/4. Now, if this was going the wrong way, it would be okay because I could just go in there and fix it if it goes the wrong way. So here's where it's located down here. So we're going to add a new account this time, save it and close it. Fixed asset cannot be, they're saying they want to make it a sub account. Okay, so I'm going to make it a sub account. Let's make it a sub account of the furniture and equipment. And they're going to say they want it to be linked to the furniture and equipment because it's an accumulated depreciation account, I believe is what they're saying here. So let's save it. I'll show you what they're talking about. So if I scroll down, now I've got the furniture and equipment, and the sub account is now indented, connected to it, kind of is the general idea. Okay. So now let's go to the balance sheet and see what it looks like here. See if I made it go the right way. Run it. So we're going to run it to refresh it. So it's not going the right way here. So, right, I put it in as a negative number thinking that it was going to be a negative asset, and it added it. So now I've got 7,500, 75,000 plus 7,500. So I'm like, dang it, I guessed wrong. So I'm going to go in here and fix it. So how can I fix it? It entered it as a journal entry. Let's go into the journal entry, and I'll just change the debits and credits. So I'll just say, all right, I want the 7,500 on this side, and then this should be the 7,500. And now let's see if that saves it. Let's go save and close it. Save transaction. Yes, por favor. And we're going to say, so now 7,500 minus the 75,000 gives us the book balance. And I can collapse this now, which is cool. That's because we made it a sub account. All right, so let's go to the next one. And we're going to say that one has been done. Going to try to, now the Visa account, similar issues with the checking account because you can connect the Visa account or credit card accounts to the bank feeds, but you're not going to have that beginning balance issue of, well, you won't have one of the beginning balance issues because there's not typically going to be any outstanding checks for the credit cards, because usually, given the fact that credit cards are electronic transfers, we don't record the transactions as they happen, but rather wait till they clear the bank, being dependent on the bank to record the transactions, meaning this balance will pretty much always tie out to the balance that is due on the credit card. However, if we enter this into our system, it still might not show up as the first beginning balance for the bank reconciliations, which we still want to do with credit cards, which isn't so much of a problem as long as you recognize that you can just check it off when you do the bank reconciliations, which we will deal with in future presentations. So let's go back on over and just add that one. Let's see if they gave us an account for a credit card and see if I can just use that one. So other current assets. So we don't have one for credit cards, it looks like. So I'm just going to add a new one. New account. It's going to be Visa. It's going to be a credit card type account. It has to be a credit card, not an other current liability, because it has a special need, the capacity to connect to the bank. So credit card type of account, credit card, okay, I'm not going to make it a sub account. It has a balance of 1,000 as of 12/31/24, and boom, Visa account. Let's save it. I think that's all we need to do. So if I scroll down, we've got the other current liabilities, and then where did the credit card? There it is. Credit card. Bam. Let's take a look at the balance opening, or the balance sheet. So if I run it, scrolling it down, there's the Visa credit card. Going into it to take a look at it, drilling down to the source. So we've got the credit card drilling down, and what did it use to record the transaction? An expense form, right? An expense form, opening balance, equity, but the expense, instead of decreasing the checking account, is increasing the liability. All right, that's the normal form that would be used when we buy stuff, usually with a check or with an electronic transfer, decreasing the checking account, but we can also buy it with a credit card, which would increase the liability, the expense form being the form typically generated by the bank feeds for electronic transfers for money going out from the bank, or for money that's going to go out when you purchased first with a credit card, increasing the credit card balance that would be due as a liability. They put the other side into opening balance equity. So let's go down here. Opening balance equity. There's the 1,000. MUI B to the N. Back. Let's close that one out. One more round. So now we've got the loan payable. This would be amounts that we owe to the bank possibly. Now there's a bunch of issues with loan payable, because if you pulled this from like your financial statements, you might have a short-term loan, a long-term loan. You could combine all the loans into one account, or a short-term and a long-term portion, even though you have multiple loans. The general practice, however, which I think would be best, is to combine all the loans into one account and then break out the short-term and long-term portion. I usually use the current liability, because some softwares don't allow you to pay out of the long-term liability, so they have kind of like a restriction. So I usually put the loan payable into current liability, even though there's a long-term portion for it, so that I can then break out the current and long-term portion periodically using a type of adjusting entry at the end of the period, which we'll talk more about when we get to the adjusting entries. So I know that you might be saying it should be a current liability, it should be a long-term liability if it's a loan payable, but like I said, I'm going to put most of the loans into a current portion because there will be a current portion to it, and then break out the long-term and short-term periodically, noting also I would recommend having a separate loan account for each loan rather than one loan account for multiple loans, possibly making each loan a sub-account of a parent loan account so that you can collapse the loan accounts together, because that makes it a little bit easier to track and tie out each loan account to the amortization table. Let's see if they gave us a loan kind of account. They have long-term loans here, and here it is, other current liabilities, loans payable. Perfect. That's what we want. So they have the account for us. I'll just use that one. They spelled it right, which we did not. So I'll keep their spelling so that people don't think I'm stupid. We'll try to spell it. Maybe I should spell it the way I spell it. No, use their spelling. They spell rightly. Okay, let's go. And then let's go into here, the journal entry. And as of 12/31/24, and then this is going to be the beginning balance. We're going to increase it. Now, again, this gets confusing because it's a liability. So what does it mean to increase it? If it was debits and credits, we would be increasing it with a credit. If we're talking plus and minuses, I'm assuming we're going to increase the liability, increase the negative thing, right? So I'm going to call it an increase of 22,000. And then the other side, I'm just going to dump into opening balance equity again. Just dump it in there, save it, and close it. Let's go back to the chart of the accounts, see if it shows up in this area. There it is, 22,000. Short-term business loan. Maybe I should have renamed it just loan payable. So it connects. So let's just rename it so it ties out to what we have. I'm going to edit this one. I'll just call it a loan payable, so it ties out exactly to the terminology I have over here, and then we might adjust it later to a better terminology. Let's save it. Let's go to the balance sheet and check it out. We're running long. Let's run this thing and then run it out. Run it out. There's the loan payable. Let's go into it and boom, entered with a journal entry. If I go into that, it's not going to show the register, but a journal entry with debits and the credits. Closing that out. Let's go back. The other side, go into the opening balance equity. That's where we dumped it. We didn't just put it there, we dumped it there. All right. Yeah. 22,000. There it is. All right, let's go back. So now we have all our accounts. Now notice how much longer this looks than this, because this is basically a trial balance. If I just want to look at a trial balance, let's open up a trial balance. I'm going to go back to the first tab and go down to reports. And let's just type in trial balance. Trial balance. Close up the ham boogie. Let's make it as of 01/01/24 to 12/31/24. Run it. And so now we have a much cleaner trial balance. Although it has these income accounts down below, right? But we'll deal with those later. But the general idea, all these accounts should match out now, right? So 25,000, 25,000 cash, 20,000 accounts receivable is 20,500 accounts receivable, 20,500 inventory, let's go this way. Inventory should be 2896, 2896. 7,500 accumulated depreciation, 7,500 accumulated depreciation. Contra asset account is a credit. 7,500 furniture and equipment, 7,500 furniture and equipment. And then accounts payable, 15,000. Accounts payable, 15,000. And then 1,000 for the Visa, 1,000 for the Visa. And then let's make this, let's color this one. 22,000 for the loan payable, 22,000. And then I've got this junk down here, which should be in our case in one account, 77,896. But all this stuff combines together, and it should tie out if I just mash it together. So in this viewing of it, we have the credit of 72396 opening balance equity plus the income 20,500 minus the expenses 15,000, which comes to 895. Boom. And then when I go to 2025, these two will roll into retained earnings. So let me bring this up from 01/01/25 to 12/31/25. Run it. What happens? Now we have our trial balance where this got dumped into retained earnings. So now we have opening balance 72396 plus 5500, 77,896, 77,896. Right? So it has to work. So if you're doing a new business, you have to get in your mind, it has to work. I'm not going to stress out about it. If I get all of these balances in there properly, the difference has to be an opening balance in one way or the other, either on the income statement, opening balance equity, or in retained earnings. And then all I have to do from this point is properly allocate to the proper opening equity account, meaning I don't want to have, or the proper equity account. I don't want to have opening balance equity that's ugly, looks bad, looks unprofessional, because that by its nature is a clearing account. It's a dumping ground. It's QuickBooks saying, I didn't know where to put it. So if I see that account as a professional, I'm going to I'm gonna think less of the quality of the bookkeeping, right? So we want to do a journal entry out now, taking it out of here and put it into the retained earnings. When I say I think less of it, it doesn't mean it's necessarily wrong. It's just that in my mind, it's going to say, wow, this person, the books didn't think to do that. What other errors might they have made, given the fact that maybe they don't know exactly what's happening? It's not like the end of the world or anything. I'm just saying it looks more professional to remove it so that you don't. It's like turning in a paper that's all crumpled up on a crumpled. It's got coffee stains on it and stuff. It's ugly, and it's going to make you think that they didn't put much effort into it. Let's go to the balance sheet, and you can see the same thing down here, equity down here, and once again you can see in 2024 you've got the 5,500 net income, and then the retained earnings. It gets rolled into retained earnings, and on the income statement we can see that we have income in 2024 if I run this, but nothing in 2025. That makes sense because we're going to enter the data. Did I refresh this one? Okay, I got to stop it here. We're running way long, dude. Running way long. You're pulling too much time, man. So we'll continue on and adjust equity section in a future presentation.